You don't need to work at Google to realize that housing market crash is a very popular search term these days. Of course, with the memories of the last housing market crash of 2007, 2008, still very fresh on everybody's mind, and with home prices going up rapidly, of course, a lot of people are wondering, is this going to be another bubble in the makings? If you're also wondering if 2021 is a good year to buy a house, you are not the only one. So in today's video, I would like to take a look at what happened in the years leading up to the crash of 2007 and the circumstances that surrounded that whole situation, and then we're also going to compare it to what's going on in the market today. Of course, just like everybody else, I can't predict the future, but what I can tell you is what was going on back then and what is going on today, and then by the end of the video, you can make your own informed decision if 2021 is a good year to buy a house. In my last video, I was talking about what is currently going on in the housing market here in Milwaukee and what are the forces that are driving the market. Why is inventory so low? What is restricting our supply? And where is all the demand coming from? So if you have not seen that video, definitely go and watch it. I'll put a link up here because it will give you some context and provide you with answers what is going on and what is driving the current market. Now, when we're looking back at 2008, what most people do remember is the wave of foreclosures and what it did to home prices and home values after that. What most people have forgotten about is what were the circumstances in the years leading up to that crash and what happened in the banking and mortgage industry and on Wall Street that was actually leading us to the situation that we had. So let's start with this, with a little throwback and with a refresher on what actually happened. If you have not seen the 2015 movie The Big Short with Christian Bale, Steve Carell, Ryan Gosling, Brad Pitt and many others, you should definitely watch it. And if you have seen it back then you should watch it again because you will be surprised how differently it looks in a 2021 context. The movie is based on the actual events and essentially the story of a hedge fund manager named Dr. Michael Burry, who is played by Christian Bale, and he's kind of a weird, nerdy, against the grain type of fund manager, and he is correctly predicting the subprime mortgage market crash already 2 years before it happened. So in 2005, he's analyzing data and he says, I know there is going to be a crash. Famous line in the movie is that he says, I might be early, but I know I'm right. Steve Carell plays another hedge fund manager, a guy who is basically angry with Wall Street and angry with the world. And he finds out by accident what Dr. Michael Burry is suspecting, so he decides to jump on a plane and take his team down to Florida and find out firsthand what is really going on in the housing market.
The market's in an itsy-bitsy little gully right now. It's like everybody said, okay, that was crazy, let's just all calm down. I sold that house for $350 the year it was built. 2 years later, $480. Then $585 maybe 18 months ago. This couple bought it for $650 last year. He'd let it go for that. Hi, John. No. It will break his heart, but he'll let it go.
Why is he selling?
Neither one's working right now.
Marlene, you'd say they're motivated, right?
As motivated as one can be in this neighborhood. This house on the left, I'd say they're probably motivated.
Wow, a lot of people seem very motivated.
Oh, it's just the gully.
And as his team is driving around, they're discovering subdivision after subdivision of relatively newly built homes that all have been abandoned by the owners. There's piles of mails on the floor, and the owners have just packed up and left, put the keys in the mailbox, and they're gone.
Hello? Hello? What do these go for?
So Steve Carell ends up meeting with two young mortgage brokers that are just absolutely bragging about the success they're having, getting rich on selling subprime mortgages to people who are not really qualifying.
How many loans do you write each month?
Yeah, about 60.
Yeah. What was it 4 years ago?
10, maybe 15.
Damn, I was a bartender. Now I own a boat.
You own a boat. So how many of these are adjustable rate mortgages?
Well, most.
Oh, yeah?
Yeah, I'd say about 90%. The bonuses on those skyrocketed a few years ago. Adjustables are bread and honey.
So do applicants ever get rejected?
Seriously? Look, if they get rejected, I suck at my job.
Well, even if they have no money?
Well, my firm offers ninja loans. No income, no job. I just leave the income section blank if I want. Corporate doesn't care. These people just want homes, and they go with the flow.
So he continues pulling on the thread, and he's asking if he can speak to a couple of these clients who have subprime mortgages. And he's being introduced to actually a stripper who obviously doesn't have any W-2 income, but she owns not one property. He finds out that she actually owns 6 properties. And she bought them speculating on rising home values.
200% on all my loans?
What do you mean all your loans? We're talking about 2 loans on 1 house, right?
I have 5 houses and a condo.
Hey, there's a bubble.
So what actually happened took the beginning in the late 90s when banks were making billions and billions of dollars by bundling mortgages and selling them off as derivatives or CDOs. And of course, at some point they ran out on mortgages they could bundle and sell, so they started lowering the threshold in which borrowers could qualify for a mortgage to open up the market to a bigger audience. And of course, what happened is the builders were happy to comply. They were building more and more houses for people who did not really qualify or have the income to actually afford the houses they were moving in. And to add fuel to the fire, not only did the bank lower the credit score requirements and the other qualification requirements, what they also did is they introduced very low teaser rates. So you could actually get a mortgage on a very, very low monthly payment. And what the borrowers had been told is don't worry about it, because in a few years when the teaser rate is over, you just go and refinance. Meanwhile, home builders were facing an incredible demand from the market. Their business was booming. They kept developing subdivision after subdivision and produced more homes than any time before in US history, at its peak about 1.8 million homes per year. And they did that for several years. Of course, the problem was that many of these homes were never occupied and inventory started piling up. So when you look at the inventory data from today's point of view, it does not take a rocket scientist to see what was going on. Inventory is being measured in months of supply. So how many months does it take to sell all the houses that are currently available for sale? And you can see that in the early 2000s, 4 months of inventory was always a relatively stable number. And then in 2004, 2005, inventory started creeping up to 5 months of supply, then 6 months of supply. And 6 months of supply is a critical threshold because that is what generally is considered when you're transitioning from a seller's market into a buyer's market. And inventory levels kept on rising from there on. So it was very easy to see that there was an overabundance of supply that was rising very, very quickly. And just for context, in today's market, we have less than a month. So Milwaukee has currently about 3 weeks worth of inventory as of spring 2021. One thing that is very important to understand, and I think a lot of people get this wrong, the real estate market and the stock market are 2 very different things, and they behave very differently. The stock market can turn on a dime, the market can crash on a Friday afternoon. The real estate market is moving much slower. So the bubble from 2007 actually started forming in 1999, and it took all these years from 1999 until 2007. By 2005, 2006, the signs were very visible. The writing was on the wall. It's just that nobody wanted to really admit that this is going to happen. In hindsight, when you look back on the data, it was very obvious. People could just not believe that something could fail on this scale. And this is precisely the reason why I think it's so important to keep an eye on the market. The market doesn't jump, it is moving, and you can see a change in these trends when you keep an eye on these key metrics, when you track inventory, home prices, interest rates, unemployment rates. All these things are early indicators if a trend is changing in the real estate market. It doesn't change from one day to another. So if you want to stay updated, I post a monthly real estate market update specifically here for the Milwaukee area. Please consider subscribing. I'll promise I'll keep an eye on the market and keep you posted. All right, let's take a look at the situation today and how it is different from the 2007 bubble. The first thing that we should talk about are mortgage loan or lending standards. So a lot has changed since then. The lending standards have been tightened by legislation. So we have seen a lot of consumer protection acts around the whole mortgage industry. So the whole industry is a whole lot more regulated today. And if you have recently applied for a mortgage and you had to bring documentation and proof for everything, of course, your income, your job, your assets, they pull your credit, they ask you questions about every credit card that you have on there and what's going on with that. So the borrowing standards that we have today are much, much tighter. And the Mortgage Banker Association actually has an index to measure that. And you can see how the mortgage standards were relaxed in the years going up to the 2007 crisis. And then, of course, the whole thing came crashing down, and the really tightened standards, banks did not like to lend in 2011 and 2012. And not until recent years they have started to relax the lending standards a little bit. But you have to really look at this chart to understand to what extent that relaxation of the lending standards has happened. Compared to what we have seen in the early 2000s, our lending standards today are still very, very stringent. Number 3, and very important, is housing inventory. So as you know, housing inventory is short across the US because we haven't built enough houses in the last decade. So we're short about 4 million homes. We simply have more people than we have houses, and this is causing the inventory shortage. And of course, we also have the demographic effect. So millennials have in the last years become home buyers. They are now at an age 38, 39 years old for the oldest millennials, where they don't want to rent anymore. They want to buy a home. So the homes that are being purchased, they are not being bought for speculation. They're actually being bought by first-time home buyers because they want to stop renting and they want to move in. So the demand is real. We have very low inventory, and any inventory that is currently coming on the market is very quickly absorbed by the long lines of people that are trying to get out of their rental situation and are trying to get into a home. Difference number 5, and this may be the most important one, is home affordability. So traditionally we measure home prices in US dollars, and when you look at prices in dollars, then of course you can see that prices have gone up. But when you measure home prices in affordability or in the percent of an household income that is necessary to buy a home, so how much are we spending on average on housing, then you can see that home affordability is now quite a bit lower than it has been in the early 2000s, or it has been an historic average. Inflation is definitely something you want to keep your eyes on. There's been a lot more discussion about the topic in the recent months. Actually, last week the Fed came out and indicating that they are seeing inflation rates increasing, but they are thinking it's going to be a temporary thing. So definitely something that we want to keep our eye on and see if it remains temporary or if this is going to be a change of direction in our monetary policy. The other thing to keep an eye on is interest rates, because both inflation and interest rates have a major impact on the housing market. So those are 2 risk factors that we really have to keep an eye on. So what are some of the other risk factors that we're currently seeing in the market? Widespread vaccination is definitely a factor that will probably impact the real estate market. And the theory is that with more people being vaccinated, they're going to be more comfortable making a change, putting the house on the market, actually moving. So that could lead us to very much needed inventory. We're hoping to see an impulse. But there is also the counter theory that widespread vaccination will also lead into more demand, because everybody who's selling a house is also going to be in the market buying a house. So we will see over the next 2 or 3 months how vaccination is going to impact the real estate market as we're progressing and hopefully coming to an end with COVID. Another risk factor to keep an eye on is the forbearance and eviction moratoriums. So from the numbers that we're seeing today, it does not look like they are on a scale that would actually have a major impact on the Wisconsin housing market, especially in combination with the very low unemployment rates that we're seeing currently. So Wisconsin is doing better than many states in the US. Our unemployment rate, believe it or not, I just Googled it, is down to 3.8%. So anything under 4 is considered full employment. So Wisconsin as a state has really dealt very well with the aftermath of COVID, and we have very low unemployment rate. Low unemployment rate means low defaults on mortgages, and that really curbs the inventory that we might see from people losing their homes. All right, so what does that all mean for you? Should you be buying a house in 2021 or should you hold off? So I subscribe to a lot of paid research, and all the experts in the country that are observing the housing industry, the mortgage banking industry, the Zillows of the world, the Adams, CoreLogic, Black Knight, they all seem to think that in the near future we are going to see a continuation of the trend that we have currently, which means inventory is going to remain low, house prices will continue to go up and increase over the course of this year, and we're also going to see a slight increase in mortgage rates. They've already gone up over the last couple of months, came down last week a little bit, but for the end of the year mortgage rates are predicted to be a little bit higher, not much, but a little bit higher than they are now. So if you're holding off and you're hoping that the market will change direction, then you might find yourself in a situation where you have to pay more for the same house, and you also have to finance it with higher interest rates, which means you get hit by the double whammy. What the research is saying certainly lines up with what I'm currently seeing here locally in the Milwaukee market. So it's kind of a judgment call, but if you ask me if you should be holding off, I would say the risk of holding off is greater than the risk of buying now. So bottom line, if you are financially prepared in 2021, which means that you have a stable income from a job, you have saved up money for a down payment, and you have reserves, and you have a good credit score, and you are currently renting, which means that you're losing maybe $15,000 or $20,000 a year on rent, then I think you can make a very good case, a very strong case for actually buying a home, stop renting and buying a home in 2021. Here is what Barbara Korokan from Shark Tank has to say on this topic.
It seems to me like it might be time to hit the brakes if you are a buyer out there, right? So when you see that, would your advice be maybe, wait a bit if you can here, since it seems like supply and demand is so out of whack?
No, because I don't see any end in sight. If you're going to wait even 3 months, you're going to pay another 3-4% for a house 3 months from today. So no, that's not a good philosophy. That would, you're hiding out, hoping that we have a bubble, which we're never going to, which this is nothing like a bubble. No, prices are going to keep going up.
All right, if this video helped you making a decision, please give me a thumbs up. And if you have any comments or questions, feel free to put them in the comment section below. I usually try to respond within 24 hours personally. You can also reach me on my cell phone or send me a text message, or if you prefer, you can send me an email. A lot of people are reaching out to me after they have seen one of my YouTube videos. That's all I got for you today. I'll see you next week.